Should you invest or pay off debt? You're not alone if you're in debt. Household non-housing debt has increased worldwide since 2008 to its highest level. Should you put your money in an investment or a retirement savings account? Or should you work to lower your portion of the credit card, student loan, and housing debt? Watch this video to learn the answer. I am Caden with expertise in self-development and finance. In my channel, I will tell you different ways to invest money and become a better version of yourself. Okay, let's go to the main topic. 31% of Americans in debt claim that it negatively impacts their life and that they worry about it constantly. Therefore, if doing so eases your mind, it can be in your best interest to pay off your debts after receiving a bonus. Individuals who suddenly find themselves with additional money may be tricky. Should they spend the money on investments that will increase in value over time rather than using it to pay off, or at least significantly reduce, the mountain of debt they've racked up? Any decision can be justified, depending on the situation. It can take time to choose between investing and paying off debt. You need clarification about which of these two financial objectives is more important. There are benefits to paying off your debt as rapidly as possible. However, there is a compelling argument for starting to invest early. You can choose the ideal approach for your financial circumstances by weighing the advantages and consequences of each. Important financial objectives include both saving and investing. It cannot be easy to decide how much weight to give each goal. Here are a few things to think about. Interest rate on debt. Put your attention toward paying off any high interest credit card debt first. The best method to demonstrate this is by using numbers. Compare the annual percentage rate on your credit card to the rate of return on your investments, the APR. The overall average rate of return for stock market investments is roughly 10%, whereas the typical annual percentage rate for credit cards is higher than 20%. Therefore, if you invest while carrying credit card debt, you pay a more significant interest rate on your debt than on the money you make from your investments. Unless you have a substantial investment portfolio, you ultimately lose money. When selecting how aggressively to pursue debts, it's also crucial to consider your credit utilization rate. Lower credit ratings are associated with more significant credit balances. If you don't limit your credit usage, the interest rates will be higher the next time you borrow money. Paying off debt also involves mental and emotional aspects. A weight can be lifted off your shoulders if you permanently avoid making loan or credit card payments. On the other side, delaying debt repayment results in increased strain, not to mention that you are accruing high interest rates. When enormous credit card debt is involved, it is evident that paying down debt is the best course of action. With an average credit card interest rate of 19.02%, the price of having credit card debt that needs to be paid off is excessive. Assume that a person has $10,000 credit card balance with a 19.02% APR. They would need 100 months, or roughly 8.3 years, to pay off their debt if they continued making the $200 minimum monthly payments. They would spend more than $10,000 only on interest over that time. In other words, they would pay back twice as much. Let's say you owe $10,000 at 17% interest on your credit card. If you pay $500 monthly for 24 months, you will pay off the debt and roughly $1,842 in interest fees. Let's imagine your monthly payment was reduced to $250. In such a case, paying down the total would take 60 months and you would accrue an interest of $4,862. That might be a powerful drive to help you pay off your debt as quickly as possible. It's vital to comprehend the fundamentals of investing before delving into the details. Long-term investing has a higher potential for growth, but also carries a higher risk. For instance, when you invest in stocks or equities, your money may increase due to dividend payments to shareholders or an increase in the value of the stocks you own. Consider debt repayment before investing for the following reasons. The sooner you pay off debt, the less interest you'll have to pay. You might have the extra money in your budget to save and invest if you don't have to make debt payments. Debt reduction can raise your credit score, which is crucial if you want to finance a car or a home. Why should you choose investments? Early investments, reinvesting your gains, and maintaining diversification are three strategies you may use to maximize the power of long-term investing. Sadly, younger people have lower investment tendencies than their parents. Recent Gallup research indicates that only 37% of those under the age of 35 currently make investments in the stock market, dropping from 52% before the 2008 meltdown. It's common to have a stock market phobia. Compound interest is one significant reason to begin investing sooner rather than later. The interest generated on your money is known as compounding interest. In short, the return on your investment accumulates based on your initial leading investment and earnings. Compounding can help your cash increase without requiring any further work on your part. When it comes to investing, time will be more to your advantage the younger you are when you start. Let's say you create a Roth IRA when you're 25. You make an annual contribution to your account of $6,000. That was the 2019 annual contribution cap. Assuming a 7% yearly return, your money will reach $1.28 million by the time you are 65. It would be best to balance your loan's interest rate with the anticipated investment return. Instead of using the same $10,000 to pay off a line of credit with a 4% interest rate, saving $400 on interest, it could make more financial sense to invest in a mutual fund with a projected annualized average return of 6%, earning $600 on your money. Younger investors typically gain more from investing extra cash than older investors do. When a 25-year-old invests $10,000 in a 401k fund with a projected annual yield of 8%, their initial investment will have grown to more than $217,000 thanks to compound interest. This will happen by the time they retire after 40 years, which is down to the power of compound interest. On the other hand, using $10,000 to pay off a loan with a 5% APR 3 years early should result in saving far less money on interest than you would if you invested the money over a long period. The tax advantages of carrying some loans are another reason to consider investing before paying off debt. For instance, interest on house loans and student loans is tax deductible. Deductions lower your taxable income for the year, which means the IRS will take less of your income. Optimizing investment can make sense if you have lower interest rates on the credit card or other debt amounts. If the market is doing well, the money you can make by investing in stocks, mutual funds, or other investments is greater than the interest paid on your loan. Generally speaking, investing makes sense if doing so will allow you to earn more interest on your money than your loans are now costing you. For instance, if your mortgage has a 5% interest rate and your stock market index fund is returning 10% annually, placing your additional money in the index fund will make financial sense. On the other hand, paying down your credit card debt at a 20% rate would be preferable to investing in the index fund with your spare money. Unfortunately, things can be complicated. Investments might fluctuate greatly. This index fund might increase 10% this year and decline 10% the following year. Even though some assets, such as bank certificates of deposit, CDs, and U.S. Treasury bills, offer guaranteed interest rates, these investments typically have modest rates of return that hardly ever go above those charged by credit card firms and other lenders. It's also important to remember that paying off certain debts, including mortgage interest, might result in tax benefits in some countries. Depending on your financial situation, investing your money instead of paying off your mortgage early may be advantageous due to mortgage interest tax deductions. What approach is best for you? Debt repayment should be viewed as a guaranteed return on the interest paid on the debt. Therefore, if you owe $10,000 on a credit card with 20% interest, you will receive a guaranteed 20% return, or $2,000 if you pay it off in full each year. On the other hand, the return on a subsidized Stafford loan will only be 3.5%, which is less than one-third of the average yearly return of the S&P 500 index from over the past 90 years. In other words, investing in an ETF that tracks the S&P 500 will likely yield a higher return on your capital than repaying your low-interest Stafford loan. There are always going to be exceptions to generalizations and rules of thumb. If the circumstances do not match my advice, consider it with a grain of salt. The SEC notes that only some investments can guarantee a return of at least 18%, equivalent to your high interest credit card fees. Focus on the highest rate card or loan first if you are dealing with exceptionally high interest debt. Credit card debt is the biggest threat to achieving long-term financial wellness. Loans with extremely high interest rates, such as payday loans, should be paid off in your budget with even higher priority. Ultimately, it's simple to understand the power of investing if you enjoy working with numbers. Small, consistent contributions could increase more than you anticipate. Calculating the numbers will determine if investing or paying off debt is the better course of action. In particular, paying off low interest debt sooner is not the smartest move if you expect to earn more elsewhere.